I'm Navy Dowdy, coming to you from the great Midwest here in the Chicago area with the last week in July tax tip. It's human nature, of course. We complain about our wait in line at the ice cream stand. We complain about being tired and then stay up late playing the latest game on our smart devices. Humans are funny and contradictory animals. Have you ever noticed that when you're in a conversation, people are quick to complain about their taxes? Many people who complain about their tax bill are actually paying very little compared to most folks. However, some people pay a lot of unintended or surprise taxes. An example we see a great deal are self-employed folks. They tell us, I pay too much in federal and state income taxes. But on review of their 1040 form, they actually paid very little federal or state income tax at all. The tax they're actually paying is self-employment tax. Most people lump them together and treat them as the same animal, but they are truly two different things. By incorporating, the business can avoid all self-employment tax. Even after doing formal payroll and paying FICA and FUTA through payroll, they can still often pay far less in self-employment tax since corporations can loan money to owners, pay dividends, or use other structures that do not generate W-2 wages. Why don't more self-employed people incorporate? Often somebody gave them some free advice that's limited to a smaller scope of understanding, or they just aren't qualified to give advice, but still do so anyway. Of course, at the other end of the income spectrum, many small businesses are paying way more income taxes than they have to if they would just plan their taxes like they plan other aspects of their business. Another mistake we see a lot are wage earners who perceive that they are paying a lot of tax and they are contributing to a 401k or other plan at work. Saving for retirement is good, and taking advantage of employer matching money is great, even essential. However, many of those folks, upon closer examination, because of having kids, child care, health care expenses, dependent parent expenses, spousal business losses, and on, are actually in a low tax bracket, but are using a pre-tax 401k. Let's state that another way. They are paying an effective rate of 6% income tax now, but putting money in a 401k to avoid paying some of that 6% so that in retirement they can pay the tax, which could be 20% or more. Should they not invest? Not take the free employer matching dollars? Heck no, take the free money. That is vital. In this case, however, they should simply request to have the employer offer a Roth 401k and contribute after-tax money. They can receive the same free employer match money, but pay the 6% income tax now, and then in retirement take out all the money and all the growth on that money tax-free. These are just two examples of tax savings opportunities that we've observed, but there are a great deal more that we could discuss here. Instead, we'll simply urge everyone, eat the ice cream, play the latest app after bedtime, and you'll survive. But get to a tax planner soon to work on your tax issues, as without enough retirement saved the correct way, and with Social Security basically already insolvent, they might not survive that. At least if you like living in your current lifestyle. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.